Investing. It promises so much, right? Financial freedom, building wealth, but for most people, it just ends in frustration. So why is that? In this explainer, we're going to dig into why the vast majority of investors fail, and, this is the important part, what that small, successful group does completely differently. Let's jump in.
So here's the big question, the central puzzle we're trying to solve. We all hear the amazing success stories, but the actual data? Well, it tells a very different story. Something like 80% of investors don't even meet their goals. They lose money, they barely break even, or they just get discouraged and quit altogether. And listen, this isn't just a string of bad luck, it's a predictable pattern. So, what is really going on here?
All right, so here's our game plan. First, we're going to tackle something called the investor's dilemma. Then we'll dive deep into the three biggest mistakes that trip almost everyone up: getting emotional, chasing the hot new thing, and flying blind without a plan. And then we'll wrap it all up with the winning strategy, how the pros actually do it.
Okay, first up, the investor's dilemma. This really all boils down to a super simple but incredibly powerful rule that pretty much governs the entire world of investing.
It's the 80-20 principle. You've probably heard of it. And in investing, it basically means that about 20% of the people are getting the lion's share of the returns. And the other 80%? Well, they're the ones struggling. The big takeaway here is that success isn't random. It's not a lottery. It's concentrated among a small group that is playing by a very, very different set of rules. So what's mistake number one? Oh, it is a huge one. It's letting your feelings grab the steering wheel. Because when it comes to your money, believe it or not, your own brain can be your absolute worst enemy. You know, the legendary investor Charlie Munger he absolutely nailed it with this. You can be the smartest person in the room, have a genius-level IQ, but if you can't control your emotions, you're probably going to be a terrible investor. It's a game of temperament, not just smarts. And these emotional traps, they're not just some personal weakness. No way. They are literally hardwired into our DNA. Our brains are built for surviving in the wild, not for navigating Wall Street. So when the market takes a nosedive, that triggers the exact same fight or flight response as seeing a lion, which makes us want to panic sell. That hype around a meme stock, it taps into our primal fear of missing out, our greed, that FOMO. These gut reactions kept our ancestors alive, but in the world of investing, they lead to the worst possible decisions, like buying high and selling low. And that emotional roller coaster, it leads right into our second classic mistake: chasing the market. It's this desperate attempt to perfectly time your buys and sells, and let me tell you, it almost always ends in disaster. There's this fantastic sports metaphor for it: skating to where the puck was. So many investors just look at what stock went to the moon yesterday, and then they throw all their money at it, hoping for the same ride. But here's the thing. By the time you hear about it, that opportunity is usually long gone. You're chasing history instead of looking for future value. Now, if you want to know just how dangerous this game is, look at this number: 17,715%. That is the total return you would have made on the S&P 500 if you had just stayed invested from 1930 to 2020. Through every single crash, every boom, you just held on. Okay, but now, what happens if you tried to get clever? What if you tried to time the market and you just got it a tiny bit wrong? Well, if you missed just the 10 best days in each of those decades, your massive return plummets to 28%. I mean, think about that. From over 17,000% all the way down to 28%, that is the insane cost of trying to outsmart the market. And honestly, this just perfectly proves Warren Buffett's famous quote: "The market isn't a casino that rewards frantic activity, it's a mechanism that rewards patience." Wealth simply moves from the people who can't sit still to the ones who can. It's that simple.
So, if your emotions are all over the place and you're chasing last year's winners, you are almost guaranteed to be making mistake number 3, investing without a map. A lot of people think they have a plan, but what they really have is just a vague idea, and that is not even close to the same thing. This is so important. If your plan is not physically written down, you're not really investing. You're gambling. Because when the market goes crazy, and trust me it will, you have nothing to hold on to. Your decisions just become pure reaction, driven by all that fear and greed we just talked about. A written plan is your anchor in the storm. It forces you to be logical when your gut is screaming at you to do the exact wrong thing.
And a non-negotiable part of any real plan is diversification. It's such a simple idea, right? Don't put all your eggs in one basket. By spreading your money across different kinds of investments, you're cushioning yourself from risk. So if one sector has a bad year, it's okay, because your other investments can help balance it out. It's one of the most powerful, yet simple, tools you have.
So what actually goes into a solid plan? Well, it's got to be specific. It needs to lay out your real financial situation, what comes in, what goes out. It has to define your strategy for asset allocation. It needs crystal clear rules for when you buy and when you sell. And crucially, it has to have a playbook for when things go wrong. This is what turns investing from a wild guessing game into a repeatable, boring, and successful process.
Okay, we've covered the big 3 mistakes that totally derail that 80%. So now, let's flip the script. Let's talk about the solution. How do the successful 20% of investors do it? What's their secret? Well, it's not some magic formula. It's all about having a superior mindset and a better process.
Here it is, side by side. The 80% are emotional, they're reactive, they think short-term. The winning 20%, they are the exact opposite. Being disciplined means you automate your investments. You put in the same amount every single month, no matter what. That's called dollar cost averaging. A long-term focus means you care way more about where a company's going to be in 10 years than where its stock was today. And being consistent means you just stick to the plan, even when it feels boring, because you know you're building real wealth, not just chasing a quick buck. It's not about being smarter, it's about behaving better. And why does this boring, disciplined approach work so incredibly well? It's because of what Einstein supposedly called the 8th wonder of the world, compound interest. It's the absolute magic of your money making money. To really unleash its power, you just have to do 3 simple things. Start as early as you possibly can, be relentlessly consistent, and automatically reinvest all your dividends. That's it. That's the secret sauce. Those who get it and stick with it, earn it. Those who don't, well, they end up paying it to the patient ones.
So here's what it all comes down to. The path of the 80% is paved with gut reactions and impatience. The path of the successful 20% is built on a foundation of discipline and a solid plan. You get to choose which path you're on. The absolute best time to start building that plan was yesterday. But the second best time? That's right now. So the only real question left is, are you going to invest with a plan, or are you going to let your emotions gamble with your future?
Don't forget to subscribe to the channel, like the video, and click on the bell icon to turn on notifications.